Welcome to The Explainer. Today, we're breaking down exactly how the mortgage finance industry tracks and discloses its exposure to loans in high-risk climate areas. If you've ever found yourself wondering how on earth financial institutions actually quantify the threat of extreme weather to our housing market, well, you are definitely in the right place. We're going to conduct a full technical walkthrough of the specific reporting standards that literally make this invisible risk visible to investors.
Okay, let's dive into this. How do banks actually measure the risk of the next great flood? It's a massive, frankly unprecedented collision between the traditional American dream of home ownership and the modern, unpredictable reality of extreme weather. But, financial institutions can't just guess at their risk exposure. They can't just throw a dart at a map. They need hard, quantifiable data. They need a standardized, reliable way to look at a geographic map, look at their loan portfolio, and calculate exactly what's at stake.
To do that, they rely on rigorous frameworks for sustainability accounting. Primarily, we're talking about the SASB standards, which are now part of the IFRS Foundation. This framework is absolutely crucial because it provides the exact standardized metrics that investors use to measure sustainability-related financial risks. We're going to pull directly from the Mortgage Finance Sustainability Accounting Standard today to see exactly what compliance looks like when we're talking about environmental risk.
Here's our roadmap for today's technical walkthrough. We're going to use a macro to micro funnel here. We'll start broad with 1. Climate risk in mortgages, then move to 2. Unpacking metric FMMF 450A. After that, we'll get into the weeds with 3. Defining 100-year flood zones, 4. The scope of what's included, and finally, 5. Calculating the financial threat.
All right, starting off with Section 1, Climate risk in mortgages.
To really get this, we need to set the macro-level stage for why the mortgage finance sector cares so deeply about environmental risks in the first place. The foundation of this whole issue is that an increase in extreme weather events directly hits the industry's bottom line. Hurricanes, floods, and storms don't just wash away buildings, they wash away financial stability. The standard clearly outlines that these events cause missed payments and outright loan defaults. And honestly, perhaps even more critically for the bank, these events just tank the value of the underlying assets. If the property acting as collateral is severely damaged or suddenly becomes totally uninsurable, the bank is taking a massive hit.
Moving down the funnel to Section 2, Unpacking Metric FMF 450A.1. This right here is the specific accounting metric designed to tackle this environmental threat head-on. Metric FNMF 450A.1 requires reporting entities to disclose 2 very simple but absolutely vital data points: the absolute number and the total financial value of mortgage loans located in 100-year flood zones. Now, why both? Well, the number of loans tells investors about the volume, how widespread the exposure is across a portfolio. But the value of those loans tells investors about the sheer financial magnitude. Having 10 loans worth $1 million each is a wildly different risk profile than having 10 loans worth $10 million each. By requiring both, the standard makes sure there's nowhere to hide. It's all about complete transparency.
Okay, Section 3, Defining 100-year flood zones.
So the crucial point is, what actually, legally, constitutes a 100-year flood zone? We really need to de-jargon this technical term. A 100-year flood zone absolutely does not mean an area that only floods once every century. That is a super common and incredibly dangerous misconception. As the standard strictly defines it, these are land areas subject to a 1% or greater chance of flooding in any given year. It's an annual exceedance probability. A home in this zone has a 1 in 100 chance of flooding this year, next year, and literally every single year after that.
To bring this out of the realm of pure statistics and into reality, the standard provides specific geographical examples of where these 1% risk zones actually exist. We're talking about coastal floodplains vulnerable to massive storm surges. We're talking about floodplains along major rivers that just overflow their banks during heavy seasons. And we are also talking about low-lying areas that are simply prone to ponding, when heavy rains just have nowhere to drain. If a bank underwrites a mortgage on a property sitting in any of these geographies, boom, it triggers this exact disclosure metric.
Let's look at Section 4, the scope. What is included?
Now, what's really interesting about this slide is how strictly the standard draws the boundaries around what counts as risk. If we put on our compliance officer hats for a second, the bank must count first mortgages for 1 to 4 family properties, and importantly, this is key, junior liens. That means if a bank issues a home equity line of credit, a HELOC, on a property in a flood zone, that must be tracked and disclosed too. And this applies regardless of the country the property is located in. But there are strict exclusions. The standard explicitly excludes mortgages held for sale, mortgage-backed securities, and mortgages that the entity merely services. Why? Because the goal is to measure the direct risk to the entity's own portfolio. If they're just servicing a loan, or if they've already packaged it up and sold off the risk, it simply doesn't represent that same direct default threat to their own balance sheet.
Finally, Section 5, calculating the financial threat. So we've identified the loans in the flood zones, right? But how do we calculate the actual monetary danger of the weather events themselves? What is the so what here? This introduces the companion metric to our walkthrough, metric FNNF 450A.2. It requires institutions to calculate two major figures broken down by geographical region, the total expected loss and the loss given default, or LGD. Both of these are specifically attributable to mortgage loan default and delinquency caused by weather-related natural catastrophes.
Let's break down the math behind expected loss, because it's actually pretty brilliant. Expected loss is calculated as the sum of the values of all possible loan losses. But here's the kicker. Each loss is multiplied by the probability of that loss actually occurring. It directly bakes probability into the financial model. If a total loss is highly unlikely, it weighs way less heavily on the metric. But if a partial loss is highly probable, it drives the metric right up. Alongside this is loss given default, which simply asks a very blunt question. If the borrower defaults because of a weather event, what percentage share of the asset is actually lost to the bank?
Now, the standard is highly specific about the exact triggers for these expected loss calculations. It includes meteorological events, think hurricanes and storms. It includes hydrological events, like floods, and it includes climatological events, like heat waves, droughts, and wildfires. But notice what's carefully left out. Geophysical events, things like earthquakes and volcanic eruptions, absolutely do not trigger this specific weather-related metric. The focus remains laser-targeted entirely on the risks that are shifting and changing due to climate and weather patterns.
Which leaves us with this final critical question to chew on. Based on all these meticulous disclosures, is the housing market truly prepared for changing weather patterns? By forcing institutions to clearly quantify the number, the value, and the expected loss of first and junior mortgages in 100-year flood zones, frameworks like the SASB standards ensure that the financial threat of extreme weather can't just be ignored or buried in a massive loan portfolio anymore. It is right there on the balance sheet, plain as day. Thank you so much for joining me for this technical walkthrough. I really hope this explainer has given you a much clearer, concrete understanding of exactly how climate risk is tracked in modern mortgage finance.